I'm joined today by Pawel Wroblewski, Managing Director and Portfolio Manager at ClearBridge Investments. Pawel is among the incredible investors sharing insights at the Equities Investment Forum today. Welcome, Pawel. It's great to have you with us.
Thank you for having us. It's really a pleasure to have you.
How do you see AI-driven disruption reshaping market leadership, and what implications does this have for active versus passive investment strategies?
Okay, thank you very much for the question. Well, we think this technology wave will have very meaningful implications, and as this wave is going to be bigger, and it is going to happen faster as well compared to other technology waves like the cloud, the smartphone, and other things we have seen in the past. This technology builds on the existing digital infrastructure, so it is adopted very, very fast, as you can see. Those tools are improving exponentially. Those tools are getting cheaper very quickly, so the use cases will only grow and grow. As we learn from past disruptions, those technology waves always create new leaders and disrupt existing models, like the smartphone disrupted the BlackBerry, but then they also create much bigger markets than we can imagine. Like when the smartphone was launched, no one could imagine the App Store and the Ubers and the Instagrams, right? So this will be very similar. This wave of technology will create so many new applications. We'll be able to automate so many processes with AI in healthcare, in logistics, like the list goes on, right? So businesses have to be really prepared for this, learn how to adopt this technology. But for sure, we will see leadership change. Some large companies will be challenged, and new large leaders will emerge. So we might not be talking about Mach 7. We might be talking about a Mach different number. We don't know. But definitely change is happening big and faster.
How do you integrate AI-driven disruption into your portfolio construction?
Yes, very good question. So like with other technologies, we need to have a framework. You need to kind of map how this technology is going to be adopted over time. So simplistically, we thought of this as in terms of like 3 buckets of adoption or time-wise. First, the builders, then the adopters, and finally the disruptors, just to make it simple, right? So we are in the first stage when we are building the infrastructure to power this revolution. Data centers, of course, are needed. We train the LLMs, the large language models. And as you can imagine, here we need a lot of traditional equipment, power, gas turbines, networking, cooling, etc., etc. A lot of physical infrastructure is needed. And as you can kind of see, it's a cycle. It's a big build cycle. Many cyclical companies are really benefiting from this. This cycle, we think, will last a little bit longer. These models are still being trained. We're not really using them a lot, so we need a lot of compute. So building it. So that's where we are today. The next phase, if you think about it, will be adoption, right? Companies are learning what to do with those tools. And because those tools are improving so fast, we are trying to learn super fast. Digitally native companies can adopt it a little bit easier and faster. They have the technology know-how, they have the technology leadership, they have the users, the data, and we can see benefits already emerging in some of the software-driven or social platform companies that can boost their growth by adopting some of these tools. So that's the second phase, very early. Many companies are still trying to figure out how to adopt it. And then finally, we will see the disruptors, right? So this is the new frontier in the market, where we'll see these aggressive growth companies emerge. Many of them still private, but when they come to the market, like Uber some years ago, or the Amazon 25 years ago, they will create a lot of new opportunities and a lot of wealth. So it's a multi-stage framework, and of course, active managers have to also think for this in terms of cycles and valuations, but you need that framework to guide you for the process.
So in an environment of heightened style volatility, how do you maintain style discipline while remaining adaptable to rapid market shifts?
I mean, valuation is important and diversifications are very important. Without a valuation framework, it's hard to keep the discipline. And diversification is very important to deliver risk-adjusted returns. So that's how growth managers have to think about it. Have a good framework, size the opportunities, and with that you can build valuation models. For some of these aggressive growth companies, you will have a bit of a different approach. You have to see how big is the TAM. Secular growers, it's a different valuation. You can kind of see the cash flows and value those cash flows. And for cyclical growers, the builders, the first stage, you can also think of this as a certain of a cycle. So it's up to active managers to use the correct approach for those valuations in different type of growth companies. And stay in those valuation discipline frameworks, very important. Otherwise, it's hard to find the alpha and deliver alpha. And then diversification is the second thing. Obviously, the markets will move in different cycles, and you have to be active all the time.
And how do you ensure valuation discipline when investing in AI related opportunities, especially in areas where hype may outpace fundamentals?
Yeah, I mean, there will be hype in some parts, so that's why you need this framework in terms of different type of stocks and in different time zones. We don't see excessive hype yet, to be honest, because in a sense of adoption, it is fast, but it's still very early. Simplistically, if you think about where we are just training the tool, we are not really using the tool, right? So everybody's kind of, oh, what's ChatGPT? Maybe do a few queries, right? But as you learn how to use those tools for deep research, your time spent is not a few seconds on a quick question. You actually can conduct deep research, which can take 20 minutes, hours. So as we move into that next stage of agentic AI, these automated systems, they will be running all the time, 24 hours 7, as they automate many processes in healthcare and logistics. So the compute intensity will be uncomparable to what we've seen before. So I think it's still relatively early, even in that first phase when we talk about the builders, right? It's very dynamic, obviously. Valuations can change every day, so we have to monitor this. But we think this technology, although it's coming up fast, it will last for a long time in terms of the implications for the market.
And can you explain how a diversified approach across the growth spectrum can help manage disruption and enhance long-term returns?
If you stay in the part of the market when you talk about growth managers, right? Think about growth as a spectrum, and you can deliver diversified returns playing around that spectrum, right? Companies have different stages of their life. They're young, they are cyclical, they are more mature. As we talked about the cycle for AI, you can expand this framework for every growth company out there, right? And we can observe that different type of growth companies behave differently in the market over time, right? Aggressive growers are very risky. They do very well in momentum markets. The secular growers are typically more stable. They protect the downside in shaky markets. And finally, if you think of cyclical growth, well, that's very company-specific, sector-specific, kind of idiosyncratic. So different type of market participation, different type of risk. So I think growth managers have a big opportunity here to move around these buckets of growth, depending where the valuations are. Sometimes, aggressive growth can be mispriced, like your Amazon in 2000, but you want to own it back in 2001 when it's cheaper, right? So that's where active management kicks in. Take this broad definition of growth, be very disciplined with valuations, and this way drive your risk-adjusted returns over time.
Pavel, thank you. We're going to need to leave it there and get back to the forum, but I really appreciate you sharing your expertise with us today and being a part of Global Investment Institute's Equities Investment Forum.
I appreciate it. Thank you for the event. It was very nice. Thank you.